that's really kind, and thanks very much for that intro. And yeah, I'm going to be talking about the economy. No one's allowed to leave. Come on, because there's drinks and a half hour of fun on the economy to talk about. And before I kick off, though, more formally, one of the things that I've learnt over the time being an Australian economist, looking at the Australian economy, is how important mining is. There's a million and one issues that are associated with the mining sector, as we've all been hearing for the last couple of days and we've known about for a long time. But just last week when we saw the budget handed down by Treasurer Jim Chalmers, shocked the pants off everybody. He delivered a surplus. There are a few reasons for that, but one of them was the revenue, the tax revenue, that the highly profitable mining sector paid to the government. And look, I'm not obsessed about budget surpluses and deficits, but when the economy is doing pretty well and when we've had 15 years in a row of budget deficits, having a budget surplus is not a bad thing. When we've got debt approaching $1 trillion, having a surplus is not a bad thing. And the question, I guess, for the Treasurer in the next couple of years will be, can he lock in a few more? I dare say, given the assumptions they put in the budget papers about iron ore prices, coal prices and the like, it doesn't take much in the way of a little bit of good luck for him to deliver a second surplus, but that's for next year. So, look, the economic cycle, while we've been hearing over the last couple of days about the joys of entrepreneurship, risk-taking, mining companies exploring different things. And I haven't caught all of them, but I've caught a fair few of them this morning and this afternoon. But gee, isn't it fantastic that we've got these people willing to take a chance and to find stuff, and people willing to fund it, because that's an important part of the Australian economy. However, as we are discovering, the economic cycle still matters too. If we have a high inflation environment, that has implications for business capex, it has implications for you and me and how much we're willing to invest, it has implications for whether China is going to be the massive demander of resources that are already being extracted from the ground here in Australia. So the business cycle does matter, and I'm going to spend a little bit of time about that and talk about the investment climate as well. And as you can see, well, this chart, I've got a few charts, so I won't ask for your forgiveness. It's a bit like my favourite chart's a bit like having my favourite child. I think this is one of my favourite charts at the moment. And as you can see, the COVID pandemic, world GDP, so you've got Japan, Europe and the US, went into a screaming recession. We got vaccinated, things opened up, and we sort of started to learn to live with COVID. I think that's the way that I'd like to describe it. Bang, we had GDP surging. And you've got to remember that at that time, most central banks had interest rates at effectively 0%. Our Reserve Bank had 0.1%. They were printing money, literally printing money, pumping it into the banking system. We had government spending money like crazy. The Biden administration, our own government here, and I think these are good policies. I'm not criticising them, like JobKeeper, JobSeeker, the building subsidies and these sort of things, because that recession was really deep. We thought unemployment would get to 12, 15%. And so policymakers, governments, central banks sort of threw the kitchen sink at it all. Now, when we sort of thought, well, gee, we've been locked up for a couple of years, basically. We haven't been able to travel. I've accumulated a little bit of saving because I haven't been able to spend much money. When we realised, gee, interest rates are still zero, so central banks are a bit slow to take away that policy stimulus, there was still money floating around from all that government spending, that all of a sudden, whoosh, inflation took off. So we've got this position now where we've had rate hikes everywhere around the world just about. Budgets are being tightened. We've got, what do we call it, quantitative tightening, I think it is. So the central banks are pulling cash out of the system. And look what's happened to GDP. The economies of the big three economies have fallen away very, very sharply. And the chatter in the markets, again, everybody here I'm sure follows the economic and financial market news. Will the US have a recession? Maybe. Europe in a recession? Maybe. Probably. So we've got this discussion about the economic cycle turning down. So the slowdown is very real. What happens, and this is the broad index of commodity prices, this is the CRB, the Commodities Research Bureau Index of Commodity Prices, going back about 10 years. And it's a broad basket of all the commodities that are produced around the world. And as you can see, even pre-pandemic, prices were pretty soft. they weren't doing terribly much. There was this sort of weak period where, low inflation globally, economic growth was moderate. China had been slowing down pre-pandemic again. You can see that index of commodity prices hovering around that 200 index points, give or take. Pandemic came along, whoosh, see that very sharp fall. I think even on the futures exchange, the oil price was negative for a few days. Remember that? That was really weird, wasn't it? So we had this big fall in commodity prices because no one was doing anything. No one was building. Companies were shutting down their production process. And then all of a sudden, these low interest rates, the fiscal stimulus, the living with the COVID and sort of coping with it as we all got vaccinated and these sorts of things, all of a sudden demand started picking up. And from that low point in the middle of 2020 to that peak on that index was up 165%. Now, the price of copper, iron ore, petrol, oil, gas, coal, whatever, feeds into the production process. Anybody who's run a business that requires all that stuff for the manufacturing, when you're paying that, you tend to pass it on, and that's where the inflation, a large part of the inflation came from. Commodity prices boomed, and that last little spike up, of course, was Russia-Ukraine, which, again, was not something that economists can forecast, but nonetheless, that caused that last little ramp up. Now, with the economy slowing down from the previous chart, with production levels being ramped up again, we've seen prices for most commodities starting to edge a little bit lower. That is the business cycle working. That's the effect of rate hikes. That's the effect of slowing economic growth. So the question for investment is going to be, well, when will that low point be reached? How much further will commodity prices fall before they find a base? And we know there's a cycle for commodity prices. You can see it there, down, flat for a period, down, then up. So you can see that cycle. So the big question is, when are we going to see that low point? And I think that's going to be when we get not just confirmation that the rate hiking cycle in the US and in Europe and the like has come to an end, but when we seriously, not just speculatively, but seriously start talking about rate cuts. And that might not be too far away. I know the US futures market's pricing in rate cuts, well, as soon as the next few months. Now, I think that's a little bit premature, but if we were to see the Fed in the US actually starting a rate cutting cycle by, well, let's say October, November, then all of a sudden you'll get this sort of supercharging in the global economy. The US is a major buyer of Chinese manufactured goods, so the linkage to China can be through the US manufacturing process. And that's how the commodity price cycle turns. So for Australia, we're slowing. No doubt about that. Anybody who's got a business or looks at the business cycle, looks at the hard data, can see the economy slowing. And that's because it had to. It's a slowdown we had to have. At the end of last year, inflation was at a 32-year high. We got 8%, or 7.8%. It started to turn down, but how quickly does it take, how long does it take before we get back to the RBA's target range? Unemployment was at a 48-year low. 48 years. What were you doing 48 years ago? Half of you weren't even born. So that's how long ago. And so when policymakers and business people were sort of looking at this economic climate, inflation, how do you manage it when inflation's at 8%? I've not seen that for 32 years. What do you do when you can't find workers? Unemployment's so low that labour shortage, the skills shortage was acute. And of course, with COVID, we couldn't have the immigration take to help satisfy that shortage of labour. So we had this whole cycle, I guess, of unusual things happening in the economy that most economists had never seen in their lifetime. And they were all happening at the same time. We had zero interest rates, which again, something that I hadn't seen, and in fact, had never happened in Australia before. And so we had to have that reversed. Rate hikes, yep, and a lot of them. We had to have the tightening in budget, which I've already mentioned. And they're working. The slowdown's happening. So then it begs the question, be careful what you wish for. We know that policymakers don't have a brilliant track record of sort of bringing the economy into a lovely soft landing. We sort of scoot along the bottom and then we have that recovery. They tend to get it wrong. So are we heading for a recession, dare I say the word? So there is some concern about it. I mentioned the US, Europe have a high probability of recession. And this is this debate that's sort of going on in financial markets too. Would the US prefer, and this is a sort of a legitimate question, sort of rhetorically that I'm giving it to you now, would you prefer inflation remains persistent at, let's say, 4 or 5% for the next 2 years, but not have a recession? Or if the alternatives, would you prefer a nasty recession, unemployment goes to 7, 8%, to get that inflation rate down to 2%, sort of near the target? What would you prefer? Now, this is where the hot debate is. In the US, the Federal Reserve is effectively saying we'd prefer the recession with 2% inflation rather than having inflation muddling along at 3 or 4%. It's too high. So that's why they've been hiking like crazy. That's why they've been doing that. So there's a high probability that those parts of the world fall into recession. For Australia, it's a little bit different. I think it's really unlikely that we have a recession for a couple of reasons. One is the business investment climate's pretty strong. And that is linked to both machinery and equipment investment. A lot of projects that were sort of postponed during the COVID lockdowns have now come back on stream. So if you look at the business investment expectations data that the Bureau of Statistics put out every quarter, they're pretty positive. In fact, up about 7, 8, 9%, something like that. So to get a recession, you need the rest of the economy to do pretty poorly. And our exports are doing well. We're running monthly trade surpluses of about 15 billion a month. Remember the Banana Republic, all that stuff in the mid-1980s when the commodity prices were so poor, we were running huge current account deficits. We're running monthly surpluses of 3 to 4 billion a week. Isn't that amazing? Again, thank you mining, thank you sort of the economy more broadly, but we're doing really well on that front. And that's what makes the recession hard. Plus, we've got this thing that people are talking about more and more and more, the very strong population growth that's occurring through the reopening of the borders, the skilled migration set coming through. So we don't want a recession either. Who wants a recession? It's business failures, it's high unemployment. It's not good news. Sure, it'll deliver lower inflation, but you don't need to sort of smash the economy with a sledgehammer to achieve it. And I think that's what the RBA has been muddling with over the last few months. So they paused, they put out the minutes of the May RBA board meeting, and it was a line ball decision according to their discussion. So it's a really difficult task, but we preferably don't want a recession. Now, that said, we consumers are pretty gloomy, you and me. My friends at Westpac and ANZ sort of asked consumer sentiment. In fact, we had a number come out yesterday. Sorry, I had to send these slides through a couple of days ago. So went back down again. See that little hook up in that last observation? Went all the way back down. Sorry. So we consumers are feeling pretty glum. And that's really odd with the unemployment rate so low. Why are we so pessimistic? And I think when we sort of look at it, why are we gloomy? It comes down to a couple of things. One is cost of living. The price of, with inflation at 7, 8%, the price of the stuff that we buy every day is going up a lot, but we know our wages aren't. Wages growth is still relatively low, certainly relative to inflation, so that makes us feel a bit grumpy. Interest rate hikes. Now, for some of us, that's pretty good. If you've got a few bucks in the bank, if you've got a deposit, that's good. But the majority of people, or a higher proportion of people, have a mortgage. They have a small business debt. And they're, of course, paying these higher interest rates. So consumers are feeling pretty gloomy. And the interesting thing about when consumers are gloomy, they tend to pare back their expenditure. So this left-hand chart, a little bit distorted by that COVID period in 2021, up and down a bit. But you can see the trend since the middle of last year. That purple line, mauve-coloured line, has been trending down. And remember that this is a nominal increase in retail spending. So you can see there it's about 5%. Take away 7% inflation, in real terms it's minus 2%. And so when we look at the quarterly retail sales numbers in real terms, they are in fact going down. We are spending less in the shops in volume terms than we were before. We're postponing decisions to buy that new electronic item. We're not eating out as much, we're cooking from home. We're doing these sorts of things which actually have a negative impact on retail sales. So we consumers, we're rational, we're grumpy, but we're actually changing our behaviour in response to cost of living pressures, higher interest rates and these sorts of things. And it's also showing up in the credit growth there, numbers on that right-hand panel. You can see owner-occupier credit growth starting to weaken, investor credit growth's weakening, and importantly, business is starting to scale back their borrowing. So again, not catastrophic, but turning points are the things in economics that get me really excited. If you get a trend, it's easy. When you get a turning point, that you can also get a little bit excited. So, I guess with house prices falling, you don't need to borrow as much, but we'll talk about that in a second. In fact, we'll talk about it right now. I had a chat out there before where we're having a cup of coffee about the house prices, and I get into trouble on house prices, get into some verbal fisticuffs, if you like. I think that the dominant issue on house prices is supply and demand. So when demand being driven by population growth, supply being driven by the number of new houses we build, and that's it. Interest rates, they have a cyclical effect. So when you hike, yes, it slows down house prices. When you cut it, yes, it forces them up. But the way that I counter the fact that some people say, oh, interest rates are so important for housing, is a little example from the mid-1990s. Mortgage interest rates were around about 5.5% or 6%. You buy a house in Sydney for $220,000. Fast forward to 2003 or 4, mortgage interest rates were 5.5%, 6%. A house was $500,000. Today, mortgage interest rates are 5.5% to 6%. House in Sydney is $1 million or more, a lot more than $1 million. So interest rates have clearly not driven house prices, obviously. So what has? The fact that our population is increasing so rapidly, and because of a whole lot of issues, zoning laws and these sorts of things, we're not building enough houses. So that pushes up the price. The cost of building a house, the cost of the bricks, the cement, the timber, the metal beams and all that stuff that goes into a house is going up. And of course, if you're a property developer, you're not going to build a house with these very high costs if you're going to sell it for less than it costs you to make it. So prices go up, and that's particularly been exacerbated just this last couple of years by the labour shortage. Where do you get a tradie to hammer in a nail and to put the plumbing in and to do all those sorts of things? There's not many of them around, so the labour costs have gone up. So all of that feeds into this interesting chart from my friends at CoreLogic. They produce the high frequency daily data on house prices, but you can see the trend in the 3-month rolling average in house prices. You can see the falls during last year, and then that turning point that happened in early February. You might think early February, wasn't there a rate hike in early February? Yep. And one in March? Yep. And one in May? Yep. So what happened? We had the opening of the borders, so it's not just tackling the labour shortage, the skill shortage through this massive increase in immigration, but even the foreign students coming to study at our universities. Again, it's a good thing, but they take demand for housing. They generally rent, but as landlords, they're cheering because they can get a tenant very quickly and they can bump up their rent. And that spills over into house prices. So we've got this interesting phenomenon now where house prices are going up. So that's literally, I think, because of demand and supply. Anybody who did Year 12 economics remembers that was one of the first things you learnt, supply and demand. And here's the supply of housing, building approvals. You can sort of see that little bit of a spike 18 months ago, 2 years ago, the building stimulus measures that the government put in place, federal and state governments put in place during the pandemic. Yep, good idea, it kept the economy growing. But now, all those houses sort of being completed and business companies are having it tough. Fixed price contracts have cost them dearly when the cost of the bricks and mortar and timber and these things have gone up so dramatically. So we've got this big fall in the number of new building approvals. That's going to be sort of short-term bad for GDP, of course, because we're not building this stuff. But when you sort of think forward a year or 2 or 3, if we've only got total building approvals running around about 12,000, 13,000 a month, annualise that, let's call it 150,000 a month, and we've got this massive increase in population, we're going to be short of houses. So house prices are probably going to keep going up. Now, the critical thing for investment, and this is something that we've learnt in this last 2 years, the rise in inflation has been a killer for a lot of investment returns. Inflation is not a good thing for obviously us consumers, but also for business. If business costs are going up because the cost of widgets is going up because of high inflation, it's not a good thing. But what we are seeing now, and this is my sort of, well, in my view anyway, my most interesting forecast for the next year or so, I think just as quickly as inflation went up from 2% or thereabouts to 8%, took about 18 months to 2 years, it's going to fall back to the target range, 2 to 3%. We've already started to see that. So that left-hand panel, you can sort of see the CPI from the monthly indicator turning down. You can see the 3-month moving average to try to get that turning point. I said turning points are so good. Look at that, the next couple of quarters inflation numbers should be materially lower than the last couple of years. So the big issue now is not that is inflation falling, it is. It's how quickly is it falling. Will it take 6 months, 12 months, 18 months for that inflation rate to fall. And we, unfortunately, need to see the data before we can be sure about it. But the factors that cause that inflation to lift a couple of years ago are now all turning. I'm just going to spend a minute or two on some of those. My good mates at the NAB do a business survey. And they ask businesses, they survey, I don't know, some multiple hundred businesses every month. And one of the questions, or three of the questions they ask them, what's happening to your labour costs? What's happening to your purchase costs? And what's happening to your final prices? So what are you doing to the stuff that you're selling to your customers? And as you can see, pre-pandemic, it was bouncing around at 0.5%, a quarter, give or take, consistent with low inflation. Pandemic came along, yep, that always distorts our charts. And that surge from 2021 through to the middle of last year was coincidentally like that lift in commodity prices. The cost of buying stuff went up. The cost of labour went up with the labour shortages because we couldn't find skilled workers. And then the final prices, the amount that I'm charging you as my customers, also went up. I had to try to maintain my margins. That's the 8% inflation rate that we were seeing. Look at the last 6 to 8 to 9 months. Purchase costs are going down, labour costs are going down, final prices are going down. So you don't have to be John Maynard Keynes to realise that if you overlay this against the inflation rate, with a bit of a lag, we're going to be seeing inflation falling. The other thing, look around the world. Australia's not the Lone Ranger. We're part of this global inflation picture. You can see there, the UK, US, New Zealand, Canada, Europe, even Japan had inflation picking up through the last 18 months or 2 years. But again, look at the turning point. Look what happened in around the middle of last year or the latter part of last year. Inflation everywhere started turning down. The commodity price cycle was turning down. The economies were slowing. We had rate hikes. We had no more fiscal policy stimulus. So inflation trended back lower. And while there's still this little bit of a discussion about how quickly will it fall, again, it's the direction and those turning points that get me worked up. Oh, and we can have a look at some of the supply chain indicators on this left-hand chart. Apologies for those black lines. I don't know quite where they came from, but anyway, it doesn't matter in a sense. Does anybody import containers of stuff, the 20 footers, the 40 footers? If you do, about a year ago, you knew how much it cost. And by the way, it was delayed in getting here, but you can see from that top left-hand panel, shipping container spot rates boomed. Shipping companies were closed down. People working at the ports didn't turn up to work because they had COVID. So we had all this problem of getting shipping containers. Now, all of a sudden, freight rates are back to broadly where they were pre-pandemic. And if you're an importer and you're paying $10,000 to import a 20-foot container as opposed to $2,000, you're going to pass that on. Inflation. Now that these costs are coming down, you're not going to be putting up your prices. You might even discount them if there's competitiveness in your business. Delivery times. Who a year or two ago tried to buy a car or furniture? You'd have to wait a year. We had this really bizarre situation where used cars were more expensive than new cars. Remember that? And that was because you could buy a used car because it was here. If you wanted to buy a new one, you had to wait a year. And some people couldn't wait a year, so they bid up the price of used cars. Now you look at the bottom left-hand Purchasing Managers Index for delivery times, it's back to where it was pre-pandemic. You still can't necessarily get a car tomorrow, but it's back to normal. So that price, I'll call it price gouging, that some people were using when we had this delayed delivery time is no longer there. Look at the input prices on the Purchasing Managers Index. Again, falling sharply like the NAB survey. This is sort of the global one. And then look at commodity prices, the price of oil, coal, thermal and coking. Look at iron ore prices, look at base metals, look at natural gas. Again, all a little bit distorted. So think back to February 2022 when Russia-Ukraine conflict saw that last bit of a spike. But even now, it's quite amazing how the European economies that depended on Russian gas have been able to pivot relatively quickly to sourcing their gas from other countries or moving to alternative energy production. So we've got this interesting phenomenon again. That's sort of like an item by item issue for commodity prices. The aggregate picture was in that earlier chart that I showed you. So for investment trends, the global inflation outlook is really important. So if we think about the scenario, why have stock markets in broad terms found it difficult to rally in the last year or two? You know, there's been fits and starts, ups and downs and all the rest of it. I think it's because of high inflation and tighter monetary policy. You know, the big fund managers that were sitting in Boston or Frankfurt or in Tokyo or whatever, when interest rates are zero, the economy is strong, yeah, buy equities, by all means, that's terrific. Commodity prices zooming, yeah, let's pump our money into those companies as well. But when interest rates are 4 and 5%, economies are slowing down, commodity prices are weakening. Oh, if I put my money into, you know, a 10-year US bond at 3.5 or 4%, that's pretty good, as opposed to 0.5%, which it was a couple of years ago. So the asset allocation decisions has been negative for equities, which comes to the point, well, when will we get that cycle turning? And of course, I think without picking a date, because I'll get into trouble if I do that, and I can't do it, to be honest, it's when we actually get serious consideration of a rate cutting cycle starting around the world. The US will probably be the first one that does it. The markets, as we know, are so quick to respond to fresh news that if we start getting serious talk that over the next year or two there's a start of a rate cutting cycle, then all of a sudden we'll see sentiment change towards equities. And I think that's when we're going to get that little bit of excitement coming back into commodities and equities more generally. I haven't mentioned China yet, of course. It's the main driver of commodities. It's still the manufacturer of the global economy largely, even though it's diversifying its base. And its outlook is pretty good. You know, we're getting different news about how strong their economic data is post their lockdowns, which only ended, 6 months ago or thereabouts. But generally, China's stronger rather than weaker, and that's got to be a good thing too if it continues to grow. Just trying to wrap up these last few slides, and I think I've got to talk about the outlook back domestically on the labour market here, because it is an interesting thing. You know, one of the things that makes me very, very happy as an economist is unemployment, as I said, at a 48-year low, 3.5%. You can.
With the downturn in business that you mentioned, why is the bond rate they're prepared to pay the rate higher than what it has been for quite some time?
Why? Oh, because inflation has gone up. So the bond rate's gone up because inflation, it should have gone, in theory it should have gone up more. The fact that it's starting to turn is telling us that bond investors, on balance, are being a bit more optimistic about the outlook for inflation, and that's causing the bond yield to come down. And they're looking at charts like this, so your segue is perfect, because what this chart is showing is that there's an unemployment expectations that comes from the, I think it's the Westpac survey. So what do you reckon unemployment's going to be? And the red line is the actual unemployment rate measured on that left-hand panel. What's happened in the last few months? There's an expectation that unemployment will start to trend up. And for the moment, it hasn't really. It's been 3.5%, give or take, for 7 or 8 months now. Now, if this correlation holds, and I've got no reason to doubt it, particularly with the slowdown that's occurring in the economy, then in 6 to 9 months' time, what will the unemployment rate be? It's going to be around about 4.5%, from 3.5%. So a few implications from that. There'll be less income into consumers, because if you're unemployed, you don't earn much, notwithstanding the job seeker payment going up by $20. But you don't earn a lot. It does free up workers for the business sector. So you actually get the wage pressures moderating. You get that skill shortage starting to ease. And when you throw in the fact that immigration is so very, very high, skilled workers are coming into the country. There's a bit of a time lag before they actually get here, but they are coming here, that firms are able to satisfy their demand for workers, which means that wage pressures aren't as acute. Now, just at 11:30 this morning, we had the next wage number. It was 3.7 year on year, so that red line's up a little bit more. But the really important part about this wage picture, and again, wages growth of 3.5 to 4%, I think sort of like in that sort of Goldilocks level, not too hot, not too cold, just right. I think everybody's happy with 3.5, 4% wages. Workers are pretty happy, as long as inflation's low. Businesses are happy to pay it because they can attract and maintain their talent, their workers. And so what we're sort of seeing is that that wage level has picked up from the COVID pandemic. But, as I mentioned, the last 2 quarters have only been 0.8 and 0.8. We had a very big quarter. You can see that little spike back in the September quarter last year. So 0.8 for the last 2 quarters is 1.6% for 6 months. I can do my maths on stage. And that's only about 3.25%, 3.5%. So the next couple of quarters, unless there's a re-acceleration in inflation in wages, which I doubt because the unemployment rate's starting to creep up and we've got this high immigration, this annual wage number will hover around 3.5%, 3.75%. So the fears or concerns that the Reserve Bank had about a wage price spiral and all these other things isn't there. It's another reason why the RBA probably won't and certainly shouldn't cut interest rates. And so we get back to the outlook for 2024. It's a better year ahead. These forecasts, best to look at the orange bars, I guess, because they're the latest forecast or the actual for 2022. You can see the slowdown that's in 2023. And in fact, it's actually been revised higher, the growth momentum in 2023. And 2024, a decent year for global economic growth. If you're thinking about what happens to companies when the economy's growing, yeah, customers come in the door. They spend a bit of money. You make a bit of a profit. Demand for goods, demand for commodities starts to go up because the world economy is doing a little bit better. So that even though it doesn't look a huge acceleration in economic growth from that chart, going from something like 2.5% towards 3% is a lot of dollars. You know, the world economy is what now, 90 trillion US dollars, something like that per annum. So an extra 0.1 is a lot of money, put it that way. And so the key takeaways for me, and we're almost ready to sort of really hit the bar. I know you've been served drinks, but really go hard. The inflation surge is easing. Hooray, that's good news for consumers, good news for business, good news for interest rates, as in they won't keep getting hiked and hiked and hiked. So the peak in interest rates is near. Could already be here. We're very close to that sort of peak in interest rates. So that's an important part of the whole equation for the economy. We are going to see softer growth. So the numbers that will come through on the economy for the next 3, 6 to 9 months will be pretty weak. Yeah, we've got a GDP number coming out in about 2.5 weeks. It's going to be very close to zero. It's going to be quite subdued. Unemployment, yep, it'll creep up. We're probably going to be getting towards 4.5%, as I said before. So there'll be some, I don't know, some mini pessimism in the economy because it's slowing down. But, you know, the Reserve Bank, I was going to say the Reserve Bank aren't silly. Maybe I'll qualify that. We're going to get a new Reserve Bank board very soon anyway, so the new Reserve Bank won't be silly. We hope, God, yes. And even one other thing that we've learnt from both the global crisis, 12, 14, 15 years ago, goodness, and even the pandemic, is that the government sector, and this is not even a party political thing, Liberals have done it, Labor's done it. If the economy weakens, then that push to lock in a budget surplus and all the rest of it won't be so acute. They'll probably let the deficit drift a bit, which is okay, probably not great for those people who want to sort of cap the level of government debt, but it actually keeps the economy growing a little bit longer. So we've got a bit of pragmatism coming from the government and the Reserve Bank. If they find the economy's weakening, they'll cut rates. They'll cut them if the economy is weak. If we get a run of bad news on the economy, they'll cut rates, so that's good. Skill shortages for business, they're easing. I've had a couple of chats with people in the last month or two, and they are saying it's easier to get skilled workers, so that acute problem they had is no longer there, and that's good news. It means the economy can grow a little bit longer, that the lack of suitable labour is not a reason why businesses are sort of scaling back their economic activity. And as the economy slows down, demand for workers also eases. And we households, yeah, we're still going to hunker down. You know, the full effect of these rate hikes hasn't hit us yet. So that's one thing. You know, cost of living pressures are only slowly starting to reverse with wages going up and inflation coming down. But the thing that sort of gives me a little bit of optimism about the household sector, the consumer sector, is, you know, we've still got a high level of savings. Yeah, we socked a lot of money away during the pandemic. We've spent a bit of it, but we've still got that buffer, which is good news. And wages, while they're not super strong, they are lifting. Higher wages growth gives us a bit more income, and that supports spending a little bit as well. So I realise that that's about time. I'm going to be hanging around for a drink or two after that. And if you've got any questions, we've got time for a question? Yep, absolutely. So fire away if you've got any questions, or, you know, no rotten tomatoes, but any questions would be great. Thanks.
We have 2 roving microphones, so please wait. Let's take 3 or 4 questions.
Yeah, that'd be great.
And then we can have a beer and chat with you.
You're on.
A beer.
You're on.
I'll
yes.
get the ball rolling while the microphones are handed out.
Yep.
So
Yes.
the key question I think everyone in this room wants to know, maybe they don't, maybe it's only me, but I'm asking the question,
Yep.
so that's all that matters. The key question is, the share market will front run
Yes.
cycles. So if the upcoming cycle here is inflation falls, interest rates are cut, commodity prices go up,
Yep. Yeah.
how far ahead of that cycle or that train will the share market start to front run it?
There's often a few false starts in this thing too, because you get a bit of news and then it's not confirmed in the next couple of months, and so that is the glorious timing is the most difficult thing. But I think that the issue will come if we do get confirmation, rock hard confirmation that inflation is coming down. That a lot of the discussion now is about services inflation being sticky. I don't like the terminology, but we know goods inflation is coming down. So if we get some confirmation in the next couple of months, and all of a sudden we see, gee, inflation is coming back to target. Those rate cuts that are priced in the US and even here in Australia for 2024, they're going to happen. The market will go to the moon. So the timing is really difficult, but we are near the point. Depends on your appetite for risk yourself, but we're near the point where that turn is going to happen. And by near, I mean 3 to 6 months.
The share market will,
by the end of the year,
market will front run the interest
definitely.
rates,
Correct.
and it will front run commodity prices.
Correct. So in fact, we see it. Well, I don't know whether people are like me, stay up all night watching financial markets move around and all the rest of it. But when we see the bond market rally, yields fall, and anticipation. So in a way, bad news is good news.
Yes, exactly.
When you get bad news and they say, oh, that bad news on the labour market means the Fed's probably going to cut rates, stock market goes up because bond yields have come down and you get that asset allocation.
And that's the opportunity for everyone.
That's the opportunity. Correct. You're spot on. You're spot on.
Let's take a question
over
from
there.
the floor, please, Stephen.
Hello, my name's Richard Wall. Well, I've just got a question about the interest rates. It seems to be in Australia that the interest rates travel as soon as the American, or we jump up, the Americans jump up as well. It seems as though there's a bit of a connection there somewhere. But my question is that, as I understand it from the bar economists that I speak to, that if we don't stay lockstep with their interest rates, our currency will fall. And I'm just wondering if you could draw the...
Yeah, well, we don't move in lockstep. Again, what was it, 18 months ago, we were both effectively at 0%. The Fed's at 5%, we're at 3.85%. So we have under-hiked by more than a percentage point. But you're quite right, because our Aussie dollar's at 66 cents today. A year or two ago, it was at 75. So the dollar has fallen. It has fallen. And even against the euro, the Aussie's fallen about 10% against the euro over the last year or so. So that is the beauty of a floating exchange rate. There's a high dollar or a low dollar, other than if you're travelling overseas or you're an exporter or whatever, is neither here nor there. It's the safety valve for the economy. That's the reason why the floating dollar is such a good thing for the Australian economy. You might feel good when it's at 90 cents and feel bad when it's at 60 cents, but it fluctuates according to things like interest rate differentials, commodity prices, our international trade surplus. In my view, the Aussie dollar should be stronger because we're exporting our pants off at the moment. But it's not because we have not, the Reserve Bank of Australia hasn't hiked as much as the Fed. But we don't move in lockstep. We move in the same direction, but not at the same pace. It's a bit like me running against Usain Bolt. I'm running the same direction, but he's a bit quicker than me.
Thanks a lot.
The gentleman up the back, please.
Yeah.
Hi, my name is Arthur Harris. The interest rate reflects the cost of money. So isn't the interest rate then reflected in the price of all goods and services? And as the interest rate rises, therefore inflation is also rising?
Yeah, well, firms do pass on. But in very simple terms, firms have three big costs. The cost of their inputs, raw materials and electricity and computer equipment, all that sort of stuff. Labour costs, wages and all that stuff. And their debt servicing costs, interest rates. And most businesses have overdraft or debt or something like that. And they try to recoup that, of course. When costs go up, they try to recoup it by putting up their prices. And in fact, some of the debate about why rents are so high at the moment is that landlords having confronted, landlords generally have debt. Negative gearing encourages that. We won't get into that at the moment. But so that when their interest repayments go up, they're trying to put up their dwelling rent to cover that higher cost. So you're right, but interest rates go up and down. There's a cycle, and so I suppose when the rate cuts come, if they come, in 6 months, 9 months, 12 months' time, you know, the cost of running a business will come down as well. So there's other costs other than interests that are very, very important. And the other thing about interest rates is if I've got a mortgage and my repayments have gone up by $500 a month or whatever it is, $1,000 a month, that $1,000 a month that I'm now using to service my mortgage means I'm not going to go to your coffee shop. I'm not going to buy that new TV from Harvey Norman. That one I've got's okay. I might cancel my subscription to Netflix and not get the dog washed or something, you know. So you can change your pattern of spending because interest rates. So if you're the person who owns the dog washing company, you think, oh, gee, no one's coming to me anymore. I better discount to sort of get people coming through, and that's how inflation starts to fall.
Let's take one more question, and then you've earned a drink. Yes, please, sir. You haven't got a microphone. If you bellow, I'll repeat it.
Shout out loud.
Hang on, you do have a microphone.
It's on its way. It's on its way.
Stephen, thanks. Great presentation. I'm guessing that amongst this audience there's a percentage of us who'd be quite happy if the gold price continued to do what we've seen it do in the last little while.
Yeah.
But for up until quite recent times, the gold bugs amongst us have been disappointed, I think, because for some while we've looked at reserve banks being silly. We've looked at inflation going ahead nicely, the sorts of things that might trigger an increase in the gold price. It took a while to happen. We're now starting to see a shift, at least in Aussie dollar terms. We're close to historical high prices for gold. But if, as you guess, the reserve banks might get sensible, or if, as you guess, inflation might come down, does that also mean that perhaps we might see that we're running out of steam with the current push upwards on the gold price?
I think there's some time to run for that. And the other thing to remember is that during uncertainty, central banks have actually been buying gold while their interest rate policy's been down and up and zero and all the rest of it. You know, putting that aside for a second, there's still strong buying by central banks of gold. And that's been one reason why it's 2,000 plus US and out. So the Aussie price has sort of gone exceptionally well. So, I think if we do get this period where the fear factor sort of abates a bit, and things like the US debt ceiling, I don't know if you're following that debate, but there's a risk that there's going to be some impasse in Congress and things like that. They're good for risky assets. I think I'd class gold as a risk asset. So if things like that sort of continue to bubble along or get worse, heaven forbid, you know, the China-Taiwan problems, again, hopefully we don't go there, but if it does happen or even turns into a trade war rather than a guns war, if that makes sense, you know, it's going to be sort of one where people do rush away from buying stocks and things and they'll move into sort of, you know, high-risk precious metals. I think that's...
We'll leave the questions there. We're going to move on, and you well and truly earn a beer, but I'm sure you're happy to have a quick chat over a drink.
Yeah, for sure.
Ladies and gentlemen, please thank Stephen Koukoulas.
Thanks a lot. Cheers, thank you.
I'd like to invite Sophie.